Really, for new relationships, we're a lot more skeptical. We obviously want to see you lock up the deal, have it in our contract, but we'll look at it right away. We're kind of interested or not interested in like 2 or 3 days. Like we're not going to sit and stall on you. Like this looks like crap. See you later. No. Or like, cool, this is interesting. Take a look. References. Who do you know? Most family offices aren't coming in from like a cold email or a cold LP or some broker sending it to us. It's just no one trusts you. No one knows you. I'm not writing you a big check.
Today, we are honored to have Ian Djuric, a distinguished leader in the world of family offices and real estate investments. Ian brings a unique perspective, having built a prolific career around the waste management industry before transitioning to oversee the Djuric Family Office's expansive real estate portfolio. With a keen eye for opportunity and a wealth of operational expertise, Ian has guided the family office into amassing an impressive multifamily portfolio spanning multiple markets and multiple asset classes across the United States. This diversified approach, coupled with a strategic focus on multiple asset classes, has positioned this family office as a formidable player in the real estate investment landscape. So, welcome, Ian.
Thanks for having me, Nathan. I appreciate it.
Absolutely. So, for those listeners who aren't familiar with what a family office is, can you kind of describe what it is and what purpose it serves?
Sure. A family office is for more high net worth people that maybe had an exit or coming from generational wealth. It's more of an investment slash trust vehicle to invest out of or to control, generate wealth, kind of for families and future generations. So a trust slash investment vehicle.
Yeah, the truest form of kind of legacy wealth in that sense. What was your kind of your background, your story before kind of getting into real estate? Because I know you had a wealth of experience with both, with waste management. Now you're kind of in the wealth management space. I'm kind of curious how you made that transition.
Sure. So I'm just a hustler that made it in life, as I always say. I started off selling trash service door to door way back in the day. Kind of got smart, understood what recurring revenue was. So I started my own trash company. I did that my freshman year in college. Went ahead and built that up to one of the top 100 trash recycling companies in the US and Canada. I did that for about 10 years. Took a very large exit to a PE firm out of New York City and kind of formed our family office after that. Being in my early 30s, I really wanted to kind of try and control our wealth. I didn't want to just sit back and be a passive LP, although we very much still are a passive LP in many ways, but really wanted to dive into it. So obviously the trash company was a pretty decent size. So we've been a decent size LP for a while owning the trash company. So we've been LPing into multifamily and a variety of other alternatives. And I went to my two favorite sponsors, said, hey guys, we're going to jump into real estate. We want to jump in real hard. Here's the deal. I'm going to fully fund your next deals and I'm going to run half it, or I'm going to run it and you can babysit. It took some negotiations back and forth, but they both said yes. So we spent about $23 million and purchased two deals and I ran them, spent the time just doing everything from leasing to assistant manager, which is more collections base and renewals to the asset management and construction side of it. Learned a lot of phenomenal lessons there. Definitely learned how to over renovate very quickly. Learned some very quick lessons, but did very well. Again, fast for about 7 years, we managed about $2.1 billion in assets kind of across the US, a mix of new construction, multifamily, with a heavy investment from our side, as well as from some outside other family office investors and some institutional focus.
Yeah, I love that. Yeah, I always love kind of operators that, have been boots in the ground and have kind of done the full scope, because there's a lot of operators out there that will come in and just kind of work at the asset management level, but it's nice to have somebody who has done kind of the more boots in the ground, kind of taken a deal kind of from start to finish at all different kind of, levels of operations. Did you have any real estate experience prior to forming the family office? Because it sounds like you had extensive operational experience with the waste management. You had this large equity check. And then it sounded like a pretty, risky move to kind of move into a deal and say, let me, control this from start to finish.
So we've been investing as an LP. So we had a small idea of what it was. And we had some decent asset management experience from investing all of our larger LP dollars from the trash side. But we had about 87 single family homes and that was fun, but an absolute nightmare at the same time. So we were so excited to dump out of that. So we understood some of the core basics in running real estate. And it's not like we had 87, but we didn't want to be the guy that had 1,200 single family homes. So we said, hey, let's package it up, sell it off. And we love multifamily, but that's why we kind of paid for education. Was I didn't just want to dive in and go spend millions of dollars just with random operators. This allowed us to truly understand the full cycle of multifamily deal or other kind of deals, and then really learn what to look for and how to interview other operators as well in terms of whether we're buying ourselves or we're allocating what we wanted to, and also the underwriting side of it as well.
Got it. Yeah, makes a lot of sense. And what's kind of the appeal of multifamily as it comes from kind of the family office space? There's a bunch of different asset classes, and you've mentioned, investing in a variety of asset classes, but it seems like predominantly, multifamily has been kind of a steadfast go-to investment for family offices, but also for your
Multifamily for a variety of reasons. Obviously, previously had a decent amount of cash on cash. In today's market, that's incredibly tightened. But previously, for most family offices, cash on cash was nice. I mean, you're really going by the rule of 83. I mean, most family offices are looking for more of a safety play in multifamily, lower leverage, nice cash flow, really trying to hit that. Obviously, if you want to hit a high teens to 20s, we love that. But as long as you're doubling your money in 5, which is only 15% required IRR to hit, we're all happy to take that.
Yep.
So money kind of checks most of the buckets in terms of cash on cash and appreciation.
Got it. Got it. Makes a lot of sense. Can you talk a little bit about, we all know that real estate's cyclical. There's ups, there's downs. In the past, have family offices invested more heavily in multifamily? Have they kind of pulled back in recent years? What's kind of been the landscape for, at least on the family office side of things, how active they've been in the multifamily space?
So I think most family offices have been very active in the multifamily space previously, but primarily through larger funds or larger groups. I think during the COVID landscape of times, a lot of family offices took the direct approach into coming to multifamily, going more into direct investment strategies, through whether it be sponsors, whether it be the equity, preferred equity, or just buying some of their own and taking kind of a risk or teaming up and trying to take some stuff down. And sometimes that's buying it their own and bringing on an operator for some kind of a profit share piece to run those assets for them. I think today's market's obviously dried up a little bit just because it's very hard to make multifamily deals or a lot of CRE deals work in today's landscape. But definitely more active. It's been kind of a ramp and then kind of a flat hold, in my opinion. Obviously, there's a lot of money staying on the sidelines, and I think it's still staying on the sidelines waiting for something to happen. Obviously, the big Blackstone purchase was huge for everybody, as that kind of showed the bottom's near. So Blackstone usually doesn't buy before the bottom. They try and buy as close as they can to the bottom. So I think that kind of showed for a lot of people, it's like, hey, we're coming back into the market. So it's kind of the bottom. No one truly knows, but I don't think it get much worse than it can or than it was with Blackstone coming in.
Yep. Yeah, I was talking with the previous guest and they're saying that, the rate cuts that are coming up, hopefully that would be more of a kind of a symbolic, symbol of change than it was anything else. It's like, hey, the times are changing. We didn't, we didn't reduce rates for a while, but now it's kind of time where we're seeing inflation come back into control. And now we're going to actually ready to move forward. And I think that's when a lot of the institutional capitalists and stay on the sidelines will kind of get back into the fold. Where do you prefer to sit in the capital stack as a family office? Is it at the LP level? Do you come in at pref equity? Do you prefer to be kind of more of a JV operator, partner? Ideally, kind of where do you like to sit?
So I think I'll touch on a couple, like personally, we really prefer the equity side. With us coming in, give us a little bit more control rights. I'll just write a larger check, share a little more on the benefits of it. I think there's still a lot of family offices that are coming in on the preferred equity side. That's usually coming in through some kind of fund vehicle versus just being a direct check. Although a lot of family offices, the check size that we're writing tend just to be the full preferred equity check. But instead of having it be one deal or coming in through more of a private equity fund that allows more diversification for it for safety reasons. There's still a lot of family offices that have relationships. So obviously, when you get us into one deal, most family offices are writing $1 million for the first deal and then kind of ramping up to that $5 or $15 million check on average for future deals. But as long as you have that consistency in return profile, that larger track record, great communication, return profile, we're usually willing just to come in as an LP check. So as long as you're hitting that thing, you build the experience, or if you come highly recommended and we come in through another family office vehicle, the LP side's fine.
Got it.
But I think overall family offices are loving that kind of co-GP role because a little bit of control, especially when you're writing over $5 million into a deal or deal specific, you want a little bit more control.
Yeah. And it's the truest sense of a true partner and a true co-GP, right? It's not just an equity check and then you tack on some asset management calls. It's actually a true operational partner in the deal. Can you talk a little bit about, when you're doing your due diligence on a deal, right? There's a ton of different aspects you do your due diligence on. You can do it on the area, on the deal itself, on the sponsor. As a family office, how do you really go about, analyzing, is this a good deal and is this a good sponsor to work with moving forward?
So there's a large variety of factors that roll into that. I mean, here, your core basics. One, let's look at the sponsor's SREO, right? How many deals do they have? How many have gone full cycle? Like that's one of the biggest thing. It's great if you got 1,600 units, but if you have all of them in the past 3 years, that doesn't mean anything. Like you haven't performed, you haven't done anything. We really want to see full cycle. Like how many have gone full cycle? What are the return profiles done? We really like diving into, especially in the past couple of years, that people are in a lot of challenging situations. And it's how to do as a sponsor deal with it. How did you source extra equity? You just do a capital call. Other things is a lot of family offices ourselves have a phenomenal underwriting team or a phenomenal asset management team. So it's not directly us as the heads of family office that are doing that deep dive and due diligence, but it's our teams that are, and then we're bringing these guys in from private equity shops, from Blackstones, and like these guys make 180, 225K a year analyzing these deals for us. So we write our big checks in. So it's really having a phenomenal team, and those guys do a lot of our due diligence. As we go to get, I'd say, if you get more direct investment versus funds coming in, we'll come, if we're going to write $10 million check, we're going to look at your SRO and we're going to go show up at one of your other properties. So if you own 4 or 5 in the area, we'll fly in unannounced, visit 4 or 5 of your assets. And if they look like shit, they look like shit.
Yeah.
So we really want to, we're not going to tell you we're coming. We're just take on the jet, fly in, visit 5 places, or hop on the jet, go to 3 different states, see your stuff, and fly home. And that's what most people don't expect is bigger check writers come in and we do a lot more DD. We also really want to understand how much equity that the sponsor has in the deal as one, and I'll come back to the equity pieces. 2, how much you have in? Is it just your fees that are staying in the deal? Is it a piece of your fees? Are you doing a token 100K into your deal? We understand sponsorship have to take fees to keep lights on, to pay staffing, just like we have a large staff payroll on our end. We understand the back end of it. So we're not scared of fees, but we really want to see some kind of skin in the game. And the other biggest thing that I think a lot of family offices learned a lesson on from the past couple of years is clearly right now there's not capital calls going on. And some of the people that you've invested with, like these GPs, have some money to cover some costs. They have some money to put in. Instead of nobody likes to call, hey, we need a $5 million capital call and we have $0 to put in. Like that's a undercapitalized sponsor. And I think a lot of family offices didn't do enough due diligence in the past couple of years on the back end financials of some of these sponsors. And I think that's going to play a big role in future.
Yeah, love that. Really doing your deep dive, right? Because there's a lot of, at least sponsors I know that out there that like kind of larger equity checks and less hassle, right? Less answering questions. But when you get to kind of institutional level, especially at the family office, the pref equity, those are going to be the toughest questions that, any true partner is going to ask. And every sponsor should have an answer for those questions and liquidity to back it up.
The DD type and the questions that are asked are going to be so dynamically different from an LP investor. Your core 100K or 250K guy, like one of our underwriters, and you get on the phone with you on a group call and they're going to challenge all of your, not it'd be a dick, but like they're going to challenge all of your assumptions. Like, do you really think you can hit this? Why are you assuming this comp is national comp? When we flew out, we looked at A, B, and C comps and they're only achieving X, Y, and Z. You're doing this. Why do you leave this asset? And like, we're doing a deep dive. We're going to challenge you because, I mean, if we're writing $550 million in your deal, like, and you don't perform, we get an 8% pref, like, that's hurting.
Yeah.
Like, no, we're crying, but like, that's a hurting pain. Like, we have projections we have to hit as well as the sponsor does. And if we want you guys motivated, because if the sponsor's not going to hit a promote or return, they're much less interested in focusing on the deal. So our sponsors are actually going to hit returns, actually promote, actually make money, and they're not just hitting on fees to get to the next deal.
Got it. And when do you get involved in the process? Is it before they lock up the deal and have it under contract? Is it during the due diligence phase? When ideally do you like to get involved in the mix?
So in a couple different ways. One, if it's a current sponsor we have a lot of money with and we have a relationship with, it's a co-GP role, we'll get involved very, very early. A lot of times we're unique. Most family offices don't do it, but like we'll help with earnest money. We've signed on a variety of loans, especially when some of these loans are in the $70, $80 million range. And you really have to show that $7 to $8 million of liquid capital. That's easy for us to do. So we'll kind of sign the loan for liquidity standpoint. We signed a bunch of equity, like carve outs, kind of you guys guaranteeing more of the liability side of it. But we'll kind of step in and do that. We also sometimes have about pursuit costs and things like that as well. So for those people, like long-term relationships, we'll step in very, very early. For new relationships, we're a lot more skeptical. We obviously want to see you lock up a deal, have it in our contract, but we'll look at it right away. We're kind of interested or not interested in like 2 or 3 days. It's like, we're not going to sit and stall you like, this looks like crap, see you later. No. Or like, cool, this is interesting. Let's take a look. References, who do you know? Most family offices aren't coming in from like a cold email or a cold LP or some broker sending it to us. It's just no one trusts you, no one knows you. I'm not writing you a big check. Usually some other family office introduction, or a lot of JV equity groups offer sidecar deals for family offices. So like the JV equity group will write in 25 million, and a bunch of us will come in for $1 to $4 million to check out a new sponsor. Obviously, somebody else has put in the bigger check. We'll come in on that sidecar piece, and then we're more open to coming in there, a little more trust.
Got it. Yeah, it makes a lot of sense. Can you walk me through, a partnership or a deal that worked really well and then a partnership or a deal that didn't work super well? Obviously, no need to kind of name names, right? But I'm more interested in kind of the dynamics of what made it successful and then what made it not successful.
I think the biggest thing is a lot of people get nervous about sponsors who run from afar. So like, we're not scared of it. We manage from afar. We have the experience from managing previous companies from afar in the past. Like with Trash Company, we had sites all over the US. So we manage from afar. So we're okay with that. We're comfortable that we do that. But certain sponsors, the sponsors that were active, who actually showed up on the site, who actually were daily involved with property management, were super active, did so much better than sponsors who were not active. So we had a great deal with a sponsor. We went, I think, full cycle with them 7 times now. Probably the most active sponsor we know. We don't have that much communication with them anymore. The first couple of deals, we had a lot of communication, but they have a phenomenal portal. It has weekly updates. It's just a flow chart, just shows in, hey, we did A, B, C, and D. We're flowing along. I think we have over 27 million with them just currently. So phenomenal, very active. And it's the sponsors that are not active, that just rely on Teams or don't have enough staffing, and aren't on site. I think that's the biggest thing is sponsorship on site. People underestimate how important that is. You cannot set up and hold standards. We own a lot of Class A assets ourselves, probably from like 2017 to brand new. And it's the standards that we uphold, from perfectly swept floors to getting every part of our building power washed every single month, like on a clockwork rotation. When we walk into some of these sites, we do unannounced visits on some of our bigger LP checks 2 or 3 times a year. Like, not necessarily me personally, but like people from our team fly in. And some of the photos we get back from some of the stuff is like, it's a direct text sponsor. Like, this is dirty. This is gross. Like, where are your standards? Like, step in, and then it's not the property manager's fault. It's your fucking fault. Like, step up. As a sponsor, we require you guys to be active, to know what's going on, to hold them accountable, to keep them going. It's not a, hey, we didn't know they weren't doing this. It's a, you should be there. Not every week, not every day. Like, you're an asset manager, we get it. But like, hold them accountable. Do what you got to do. And it's the sponsors that aren't on site as much and just try and mathematically run things from phone calls that don't work out.
Yep. Yep, I love that. I used to work on site, doing property management. That was always so key to me, is that I learned the operational side from being on site rather than just sitting behind a computer. That's great. So, what are kind of the pros and cons, I guess, from like an operator standpoint of working with a family office? When would you want to work with them? When might it not be a great idea to work with a family office?
If you like to shoot from the hip, or you like to kind of do things your way, don't bother calling us. It's just not going to happen, or it's going to end really badly. We like consistency. We like structure. We like safety. We like to know what's going to happen, how it's going to happen. And then the bigger check we get, the bigger check you get, the more controls that come along with it. So if you're a super control freak and want everything and just want your passive LP money, we're not the right thing for you, because we're writing a big check. We're smart. We also know what we're doing. A lot of bigger family offices can bring value, especially in unique situations if something happens. And that's one of the differences between, I'd say, family offices and like funds. A lot of funds max out and are done after they fully allocated. And if there's a capital or something happens, or there's an opportunity to invest $2 more million in the deal and do another type of renovation and go up and expand and get another $200 a unit, or do a multifamily to condo conversion, which a lot of people are doing right now, we have the money to come back in. And like, we're not going to, do we love a capital call? No, but like, we're not going to sit back like when some of these big funds say, we don't have any money, go find it elsewhere, you're on your own. Like, we're here, we have money. We understand that not everything goes perfectly. Obviously, we're not going to be happy, but we're not going to just say, screw you guys, like, figure it out. Like, we're going to back up our money and continue to grow if we believe in the project. So big benefits are, we're here, we have the money, we can act quickly, we're more entrepreneurial. We want controls, but not massive controls. And we have backup money. So that's kind of a roundabout way of saying it.
Yeah, absolutely. And then what kind of, KPIs or metrics are you tracking to really kind of have the success of a deal? Is it something that you rely on sponsors for? Or is it something that you kind of create your own dashboard and kind of, system to make sure all the checks and balances are in place?
So we have our own asset management team for running our own multifamily deals. And so then, but for ones that we're really passive on, just as a pure LP or a coach on, like most of our asset managers, like we sit on every call. For the ones that we're a true LP on, like we sit on, but we don't say anything. We stay in our lane. We're appropriate. When there's wanted value or playing a role, our asset management team works very, very well. And they have a phenomenal dashboard of everything that we track, from renewals to leasing to actually, are we hitting the amount of renovations? Like, we're a lot more in depth than most people are, but it really depends on the passive versus active side. So on the active side, we're better KPIs, but I think the biggest things you're looking for are TDS, which I mean, just your cash on cash. And we're really looking at the back end, like, cool, like, are you on track for renovations? Are you hitting your budget for the renovations? Are you over? Are we hitting the expected rent premiums that we're going after? So really tracking the progress of the asset. And if we're not, how do we pivot? What do we do? Because here, not every renovation that we plan for works. There may have been a comp that's 2 apartment complexes down that has the same renovation and we're doing it and people just don't want it, or people want that property more still. Is it the fact that both of us missed that they have a dog park and a phenomenal gym and our gym blows? And that's why everyone's picking that property. So it's really diving into, when things don't go right, how do we pivot, fix, and move?
I love that. Because that's the whole point of having an operational partner, right? Is being able to strategize and find solutions when things don't go to perform, which is, inevitable at the end of the day. Great. And do you kind of have like predictions or things that you're seeing as kind of emerging trends for the next few years, either in the multifamily space or in kind of the private equity family office space?
Sure. I think a lot of the family office capital is still going to sit very, very tight in multifamily right now, just because I don't think the deals are there and they still don't pencil very, very well. I think there's a lot of money sitting in distressed funds that aren't going to go well, just because most of these things are getting, like, if people have a bad deal with Arbor, Lumint, whatever it is, like, they're getting sold privately. They're not going to the market. they're not available for a syndicator or sponsor to buy. They're getting sold privately through a relationship. Occasionally some come up for auction, but auctions are extremely hard for sponsors to try and go after because you have to have everything prepped, ready to move, and you can't close in time unless you have a back inside relationship with that lender. I think multifamily is going to probably take about another 18 months to really get back into in terms of being able to hit profile returns people want or the safety profile that people really want. I think multifamily is probably going to stick to a little more pref equity, especially if you're looking at like that 14, 15% IRR for return side. Like it's not quite as exciting because you can get pref for 14% and you're sitting in first position. You're writing a $5-10 million check to get in that position, which is great, but pref equity makes a lot more sense. Build to rent doesn't work right now. Building lots is phenomenal. We pivoted almost all of our build to rent product into building lots. But I think build will probably make a bigger change come back in about 12 months. So super excited to get back into build to rent. Love a larger scale of that for long-term hold. I think the biggest thing is too is like, remember, family offices are really patient. So like we're okay having our money locked up for 10 years. We're not as excited for these 2-3 year flips. Like it's not exciting for us. That means I have to invest, get it back, deal with tax stuff, and then reallocate. Like it's not that exciting to do it that often. Maybe we're a team for it, but we're not opposed to a 10-year hold. If you can show me a 17% IRR for 10 years, which is very hard to do, you get my money all day long.
Yeah.
Or if we're buying a brand new product and you can show us a way to do something creative, we can get half or more of our money out eventually and then hold it for 20 years. Cool. Excited too. I think there's going to be a bigger opportunity in family offices being involved in buying newer product at a close to replacement cost discount and holding long term for at least 10 years and then having this kind of exit. So that's kind of my thing there.
Yeah, more of a kind of a cost basis play, right? You get a discount and just kind of hold it forever. That makes sense all day long. Briefly before we end, can you talk a little bit about kind of the build to rent space, some of the challenges it's experiencing right now? Because that's kind of, at least in multifamily, kind of one of the newer asset classes that hasn't been around as long as some of the other ones. And so some folks listening might not be as familiar with what it is and kind of how it works.
So on the ownership side or the sponsorship side, which we do a lot of, we really switched much more over to build to rent probably about 2 years ago. Multifamily was great, but you kind of see the spiral of it just not going the way we wanted to for future growth. So we switched over a lot to build to rent. And it had been going phenomenal for the last 2 years. We just did 4 exits from January to March right now on 4 of them. So those are fun. It was a mix from, I think our lowest IRR was 24. I think the high was like 37. So I mean, they're not like 100% IRRs. They're not like teens, but they kind of play in that middle space, which is nice. Most of those products right now, like we're just finished one in Huntsville, Alabama, and it's a 24% fixed rate IRR return. So it's just a lot. So like the build to rent itself doesn't work because of construction costs and land basis and the moment. But once construction costs can come down about a bip and a half, you'll really start a lot more people starting to build because theoretically we can do build to rent for building from scratch, doing all townhomes. We can go into HUD and return at a minimum 85% of your money within 4.5 years and then hold. So I think you're going to see absolutely a lot of build to rent coming once you can bring down your construction cost basis and your construction loan by about 2 bips, 2.5 bips, not 2.5 bips, that's way too much, but about a bip and a half, sorry. But after 2, you're going to absolutely crush it. So once you get into the construction costs in like the 7s to 8 versus like the 9s to 11s that it is now, it'll grow phenomenally. And then refine out in that high 5s. I don't see the force coming back anytime soon, in my opinion. That you're going to be stuck in that 5, which is fine. 5 works. I mean, not getting to 5 either. I'm probably a 5.5, 5.5. But build to rent's going to be phenomenal. Remember, it's like buying brand new property. Plus, I think a lot of people and trends in the microeconomics don't want to necessarily live in the house. I mean, don't necessarily want to own a house and don't necessarily want to be in an apartment anymore. So they kind of want that townhouse vibe. They want to not just start a family, but they want that homey feel versus just like that. Apartments are loud, noisy sometimes. Like there's a lot of action going on. And a townhome, you got a little bit of noise, but you only got one neighbor versus like one on both sides and one up top and everyone. The massive parking lot, you're in a little parking spot. So I think you'll see a bigger trend. I think you'll see the exit ability of build to rent. Look at exit. 1, I can sell, I can build lots, right? 2, I can build it and hold. 3, I can build it and sell, or I can build, hold, sell. Like there's just so many exit plans and portfolios for build to rent. Probably one of the biggest reasons it's going to kind of grow compared to some of the other CRE asset classes.
Yeah, that makes a lot of sense. It makes a lot of sense. All right, especially when you're finding that middle ground space where people want a bit of a yard and homey feel and able to serve that demographic, that's ideal, especially with housing costs and kind of rents where they are right now. Great. So last question on mine, Ian, is, we talked about, operations. We talked about doing a deep dive. Are there any deals that you as a family office own solely for yourselves with no partners, maybe very little debt, that you just use a kind of more cash flow plays for your own operations?
No. So we do own stuff just by ourselves, right? But it is not with no debt and is not to hold because it just doesn't make financial sense, right? Leverage is huge in building wealth and creating wealth and growing wealth, right? I mean, if we were $1 billion company, sure. But at the same time, like if you buy a multifamily thing, it's one thing if you can refinance all your equity out and then hold. But it's here, I'd rather put my money in debt or a hard money fund is returning 8 to 10% current, bridge debt, or even lower lever bridge debt, or there's a variety of other alternative vehicles in the space or other spaces that pay off better than owning a multifamily asset with no debt. So I love the safety aspect of it, and it's nice to have it. I also like I don't want to say fire is not the right word, but I'm drawing a blank my adjectives right now. But having the pressure from having a loan or mortgage requires you to hit numbers. Like it's a thing in the background, like I got to pay my mortgage. I can't have bad months. I can't do, cool, we're only down to 88%. We're fine. Like, no, we got mortgages, we got expenses. Let's step up. Am I much happier here? The one that we have, the last one we own is in Houston. It's a 2021 product. Again, I knew, right? But we're at a 55% leverage rate. So we're probably not going over 60 for some of the longer term direct holds. They're also smaller. I think it's like 120 units. So it's smaller, but nice, safe, and easy.
Yeah, awesome.
The jabbled answer, but
yeah, no, I loved it. I loved it. We dived into a lot today. You know, we talked about operations, how to vet sponsors, what you're looking for, kind of emerging trends in the family office space, any kind of other golden nuggets or, you know, things that people should look out for if they're thinking of engaging with a family office or using them as a partner or a kind of an LP on their own deals.
A couple things. So one unique thing that we do, and we do it because we have a big balance sheet behind us because we're a family office, but family offices are very nervous about getting in with new sponsors, like very nervous. So be creative with it. I mean, don't give it all away, but like for family office to come and invest with us, we say, hey, come in, bring in your first $1 million, come in super small, super tiny. I don't care if your average check's 15, come in for $1 million. We'll personally guarantee your $1 million. Come in, zero loss risk. Obviously my balance sheet's 9 figures high. Come and invest $1 million, watch us perform, do your thing. That way you have no risk. Like we're not going to guarantee your profit by any means, like any kind of return, but it's a safety play for them. So if you can financially do something unique like that, don't be afraid to do that. Or two, have them going for $1 million. If you got $20 million raise, you want to build a relationship, give them a deal level return. What do you really care about not making your money on $1 million, your $20 million deal, right? If you want to build a new relationship with someone that can write you a $5 million check or $15 million check in the future, give up making a couple $100,000 on one deal to get them in, perform your butt off, and then cool, now you got a relationship as long as you run that relationship well for those first 3 to 5 years, right?
Yep.
And they're probably coming back at year 2, right? They want to see some consistency. They want to see the operate, how you report, how you communicate, the cash on cash returns, actually watch you deliver on those NOI boosts, but they'll probably come back in year 2. I definitely wouldn't be like, cool, hey, thanks for coming in. 3 months later, 6 months later, like these are where we think long-term. They're long-term relationships. Don't start banging me out on every single email. And I would craft, if you're targeting, find a way to get into us. Like I would say we probably get 17 to 25 deals a week just into our inbox at a bare minimum. And we don't even read all of them. Like there's so many that come in. So it's find a way. And here, a family office club is not the way to meet a family office. I'll bluntly say that. I was in a family office club and a variety of other family office groups from a sponsorship side and from a family office side. Don't waste your money in family office club, but find more unique things. So like there's other groups like Carmano companies. There's private people accept invitation, or just get in with one family office. And then most of us know like 800 others. And we're going to we like to invest together. We like to take down entire deals. Like we like the control rights of it. So like we're more likely to say, hey, Sean, hey, Kelly, come on, let's all put $5 million to take down the whole deal. And then for doing that, we're going to negotiate a better deal for ourselves and have some control rights. And then you just knocked out an entire deal in about 2 days.
Yeah.
Nuggets.
I love that. I love that. And that's also kind of the name of the game, right? You said perform your butt off. And I feel like that's really 2024 and 2025. That's kind of the name for name of the game for a lot of operators out there.
Maybe one last thing is just say over communicate, but necessary information. Don't communicate bad, like unnecessary information. But one of the biggest things that we like, and one of the biggest ways we communicate with our investors is by video. It shows that we're on site. We are consistently, like we're doing a hotel to multifamily conversion right now. And then we're also building a construction site in Turks and Caicos. So like every week there's a video uploaded to our portal of the Turks and Caicos construction site. Like, hey, here's what we did. It's up 30 seconds. It doesn't go to your email, but it's in the site. You can log in, you can see it. We don't blast weekly things on every site to its email, but we communicate and be unique about it. Like, cool, like look what they actually did. And like we get the drone videos, we get the drone photos, we walk through. And even let's go back to due diligence for 2 more seconds, right? One of the things we did in our last deal was we went in, it's fun to do, but we took video of the comp that we're doing. Like, hey, these are all the things they're doing. Here's the comp, here's the rent, here's everything. And then we went to the site that we were buying and showed, here's what we're going to do. So investors could see, like, here's the comp, get the visual for it. People are visual. They want that nowadays versus just like, oh, hey, there's this comp down the road that is A, B, and C, and we're going to do A. Show me, show them. And then two, like once you've done it, show them, like send the video, like, hey, here's the old, here's the new. I mean, don't show the actual lease itself, but like we're achieving the $261, or hey, you know what? We actually achieved more. We achieved $20 less. Like I'm not going to complain if you're in for 261, you hit 241, like boo. But like that's still $241 rent premium. Like let's go. Be a little bit excited about it.
Yeah.
So it's also like building that relationship is huge because once you build that relationship and it grows, like family offices will invest with you for the next 30 years.
Yeah.
Those that want to grow and be in this game for a long time, family office can be huge.
Awesome. It's a long-term play. Well, Ian, I appreciate it. And your time is very valuable. So I appreciate you sticking on. If our listeners want to get a hold of you, how do they reach out?
Just BlakeCapitalGroup.com, Ian at BlakeCapitalGroup.com, and any of our investment team or anybody else would be happy to help you guys out. Or Djuric Family Office at Instagram. The funnest way to keep track with us and watch what we do.
For all those visual learners. All right. Love it, Ian. Thanks so much.
Thank you, Nathan. Appreciate it. Have a great day, guys.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.